Hey everyone, welcome back to the series where we go through multiple choice questions. And now we are up to the audit module 4 quiz. I'm not going to preface it with any more information because I've already gone through that in each of the preceding 3 quizzes. So I think you've got the hang of what the purpose is. So let's just jump right into the first question without further ado. So the auditor's report is to be completed and signed on 26th of August 20X9. For which of the following material events occurring subsequent to 30 June 2019 balance date would the auditor require disclosure in the subsequent events note to the financial statements? A. The undertaking of negotiations to secure the services of the CFO of your major competitor. B. An adjustment for an inventory that was purchased before year-end but had sold after year-end for an amount substantially below its cost price. C. The acquisition of a subsidiary on 23rd of July that was expected to increase sales for the consolidated entity by 25% in the next financial year. Negotiations had begun on 8th of June 20X9. And D. The refusal to adjust inventory for an obsolescence write-down identified by the auditor. This did not result in a modified auditor's opinion because the auditor and a client agreed that the amount was immaterial to the financial statements. So this question is in relation to subsequent events. So how I would recommend approaching this question is to bring up your notes and do a Control F for subsequent events. Or if you've got a printed version of the notes, maybe just, and you've tabulated it, quickly flick to the tab, or if you haven't tabulated yet, put a tab here. And the more often we come across a certain topic, the more likely it is that you will need a tab, and when you get to your exam, you can just go quickly flick to the tab. Okay, so anyway, let's pull up the notes now for the relevant section on subsequent events. So we touched on this a little bit in the last video, but subsequent events are basically events that occur after period end. So for example, if they're a December year end, this might, occur on between 1 Jan and whenever the date of the auditor's report is. Maybe that's 6 months later, right? So in this case, the question is, so the financial statements are a 30 June year end. So if this event has most likely taken place between 1 July and 26th of August 20X9. So basically these events are stuff that's happened after reporting, after the reporting period is finished, but if it's material, we still need to make an adjustment, whether that's either a disclosure or if it's material enough, and depending on whether events existed in relation to it at the time of the reporting period, we might actually have to make an adjustment to the financial statements. So it's the same flow chart that we went through in the previous one. So basically, the first question is, does the subsequent event provide additional information about an event that existed at the end of the reporting period? If the answer is yes, then it's an adjusting an event after the reporting period. An adjustment is required, and you adjust the profit and loss. But if it's new information, like if it's in relation to an event that did not have anything existing at the end of the reporting period, it's a non-adjusting event, and then there's no adjustment permitted. But depending on whether the information is material or not, you do need to make a disclosure, right? And obviously, if something has arisen after and it's not material, then no disclosure is required. So taking that into account, let's go through each of these. So the first one, undertaking of negotiations to secure the services of the CFO of your major competitor. This is not a disclosing event, right? It's not material. It's not an event that's happened after reporting period. It's not something that you just need to report, right? So A is not correct. It's not going to impact your financial statements, right? So B is adjustment for inventory that was purchased before year-end but had sold after year-end for an amount substantially below its cost price. I mean, this isn't a material event either, right? So we're talking about, one piece of inventory. It's going to cost, like 10, 20K at most in a business that could be trading in the millions, right? It's just not material. So it's not material enough to have an impact on the financial statements, therefore it's not a subsequent event or adjusting event, right? So C, the acquisition of subsidiary. So any acquisition, anytime you see an acquisition, we know that's a material event. Buying a business could cost in the millions of dollars. It's going to change how the business operates. It's something the shareholders should be aware of. It's always a material event when there's an acquisition. So there's an acquisition on 23rd of July 2019, which is after the 30 June balance date. So therefore it would be a subsequent event, and we agreed that it is a material event. So far so good. So this was expected to increase sales for the consolidated entity by 25% in the next financial year. Negotiation had begun on 8th of June 2019. So the question is, did this exist at the time of the balance date? So let's apply the flowchart to this again. So bringing this over here. So does the subsequent event provide additional information about an event that existed at the end of reporting period? So again, acquisitions, yes, even though there is negotiations, it didn't necessarily exist at that point in time. There was no binding document. It was purely just negotiations. There was nothing binding. So the answer to that is no. If there was a sale agreement at that point, potentially we could say yes, but there wasn't. So no, so it's a non-adjusting event after the reporting period. No adjustment is permitted, but depending on if it's material, there might be disclosure required. So an acquisition would be material, so yes, so disclosure would be required, and we would need to put in a notes to the financial statements. So the question is asking us which of these events would trigger a disclosure in the subsequent events notes. It would be this acquisition here because it satisfied the requirements of this flowchart. But let's just double check D just in case we missed something. So the refusal to adjust inventory for an obsolescence write-down identified by the auditor. This did not result in a modified auditor's opinion because the auditor agreed that the amount was immaterial. So there you have it there. It says right there it's an immaterial. Anything immaterial we don't need to disclose for. So clearly the answer is C. We can move on to the next question. Okay, question 2. A letter addressed by management to auditors and that confirms in writing any statements made by management to the auditors during the course of an audit is commonly referred to as A, a management letter, B, an engagement letter, C, an audit representation letter, or D, a management representation letter. So this is a question which we kind of touched on in the last video as well. Now hopefully you know from the core content what the answer is already. This will save you some time. Instead of having to refer to the notes, you can quickly click on the answer, which hopefully you know is this one, a management representation letter. If you didn't know that, that's okay. What you could do is you could either search some of the keywords up here, or you could alternatively just do a Control F in the notes for some of the keywords in the answers. So hopefully you would have thought maybe the answer is management representation letter. So what we can do is in the notes, just do a Control F for management rep, just to save a little bit of time. And then go to this one here, management representation letter. And we'll just do a quick recap for the benefit of you. So basically what it is it's a letter. It's usual process for the auditor to obtain this letter from organization's management, so they're the ones drafting it, which contains representations from management to an auditor. So the purpose of the letter is basically two things. Number one, it impresses upon management that it's the ultimate responsibility of the financial statements lies with management of the company, not the auditor. And secondly, it confirms in writing any representations made by management during the conduct of the audit. So that's basically what fits in with this question overview. So let's just go ahead and click D in the essence of time. So next question, question 3. So the auditor has concluded that a significant going concern uncertainty exists at Client Co. Which of the following procedures is least likely to provide useful evidence as the ability of Client Co. to continue as a going concern? So I mean, we've talked about going concern in some of the previous videos as well. Just to quickly recap what it is, going concern relates to the business's ability to continue to operate into the future, and that means having enough revenue and profit in order to sustain its short-term and long-term obligations, and that cash flow meets all of its obligations as well, right? So which one of these do you think, and we're not going to check our notes for this because we can work, this is a logic-based question that we can work through based on our existing foundational knowledge. So A is analyzing and discussing cash flow forecasts, cash flow and profit forecasts with management. I mean, cash flow reports is a super important for understanding going concern. However, if you're doing an audit, you don't use forecasts, right? You use historical information for a couple of reasons. Number one, the subject matter is always historical financial information, and that's what you're checking. You're not checking future reports. But it's better than nothing, right? It's better to use a cash flow report and forecast into the future because we're considering whether the business's obligations in the future are sustainable as well. So that potentially is okay. Remember, we're looking for the least likely option, right? So let's leave that one to the side, probably correct. So B is examining related party transactions to identify potential sources of finance. Look, a related party transaction in particular, and they're specified as a source of finance, is going to be a historical thing, right? With cash flow and going concern, we want to know future cash flows and whether we think the business has enough cash flow from the business to support its short-term and long-term obligations. So these are existing, sources of financial, these are existing obligations. It's not really going to help with making an assessment on the business's future potential, right? It's more of an existing historical transaction. But let's keep it in the back pocket. But so far, this is the least likely to provide useful evidence. Okay, next one is C, reviewing the terms of the loan agreements and determining whether any have been breached. So potentially this could be useful information because A, we need to know what the terms of the loan agreements are because of debt covenants. So debt covenants are basically restrictions on debt that the bank has over your business. So if you breach a certain covenant, the bank can come and say, I want my loan repaid, or I can put up interest rates. And if they can cut funding, that's going to be a huge impact. It's going to be a huge risk to going concern. Particularly determining whether any of those have been breached is very important. So yes, this is a useful piece of information. And then finally, reviewing events after period end to identify those that either mitigate or otherwise affect the entity's ability to continue as a going concern. So this is definitely important. I mean, it even specifically mentions going concern in the answer. But just because we're looking at historical financial information in the audit doesn't mean that something hasn't immediately after the end of the financial reporting period, which might threaten the going concern of the company. For example, a fire in the warehouse, which destroys its stock, the acquisition of an unprofitable company, a bank coming and saying, if you breached your debt covenants and therefore I want to, recall the loan, a breakdown in shipping products, a recall in the product, something like that, right? So all of those things could affect the going concern assumption of the business. So out of all of those things, the future cash flow forecast was useful to determine, future cash flows. So sorry, I went down the wrong path initially, but no, this is definitely a very useful, if not the most important thing of identifying, cash flow and therefore going concern. B wasn't really useful because it was historical and already done. C was important because of the risk of debt covenants being breached either now or in future, and then this one was important because we're looking for any out of the ordinary risk after the reporting period which might impact going concern. So clearly B is the least likely or least helpful one there. All right, next question, question 4. A refusal by the directors to furnish a written representation stating that they have fulfilled their responsibility for the preparation of the financial statements in accordance with the applicable financial reporting framework constitutes. So basically, in other words, the directors don't want to write a letter saying that they've fulfilled their responsibilities. So what will this constitute? A situation sufficient to preclude an unmodified opinion. B, a situation in which the auditor must seek alternative sources of evidence. C, prima facie evidence that the financial statements are not presented fairly. Or D, a situation in which the auditor can still issue an unmodified opinion if the risk of material misstatement at the assertion level have been reduced to an acceptable level. So this one's a little bit of a challenging one. So what I'm going to do is I'm going to do a Control F in the notes for written representation, because that's the key point there, because we want to know what happens when the directors don't provide written representation. So I've done a Control F in the notes. It's come up with a few different options here. Not many, 1, 2, 3, 4, 5, 6, 7, 8. So I basically took one here, went to ISA 580 written representation, but really you can choose any of them. They're all pretty close to each other. And I just scrolled down a little bit and it says, when an auditor requests for written representations and they are not provided by management, ISA 580 paragraph 20 states that the auditor shall issue a disclaimer of opinion which would preclude, in brackets, in other words, prevent, an unmodified opinion and raises doubts for the auditor about management's integrity. So let's see which one of these answers is most similar to what we have in the notes there. So a situation sufficient to preclude an unmodified opinion seems pretty close to what we've got here, which would preclude an unmodified opinion. So I don't think we need to go any further because the answer is clearly just A. So let's just go ahead and select that, and it's the correct answer. Cool. All right, next question. Your audit client has not written inventory down to net realizable value in accordance with IAS 2 inventories. So remember from financial reporting is that inventory needs to be recorded according to IAS 2 as the lower of cost and net realizable value. So cost is what you paid for it, and net realizable value is what you can get for it in today's market. So if there's obsolescence, your net realizable value is going to be much lower, and therefore you need to record your inventory at that valuation, not what you paid for it. So the write-down would has not written inventory. So this person's just left it at cost, but in reality that net realizable value is 15% lower. So what type of audit opinion should you issue? A qualified opinion, B, an adverse opinion, C, a disclosure as a key audit matter, or D, an unmodified opinion with an emphasis of matter paragraph. So I think what we should do here is quickly recap what the different types of opinions are and what they mean. So it's basically, aside from an unmodified opinion, which is basically there's no issues, the four kinds of opinions which are modified, right? And when we say modified, we mean modified from unmodified. Unmodified is a good one, modified is a bad one, right? So there's four kinds, well actually three kinds that we need to go through. There is adverse opinion, there is qualified opinion, there is disclaimer of opinion. So those are the three key ones that we need to go through. So these are the issues or matters that give rise to a modified opinion. So there's two categories of matter that give rise. Number one, the financial statements are materially misstated, or number two, the auditor is unable to obtain sufficient appropriate audit evidence. So it's either they found something and it's, something's, making the accounts wrong, or the auditor can't get in there to check if it's wrong or not. So we've got to assume that it's wrong, basically. So in this situation over here, we've got a situation where the auditor's got enough information. That's not the issue. The issue is that the accounts are materially misstated, right? So current assets, not just inventory, but current assets are 15% overstated. Now, in any audit, that would be a material adjustment required. So clearly, it's going to be in this category here, where the financial statements are materially misstated. Now, the next section that we need to fill in to determine whether it's an adverse opinion or a qualified opinion is... sorry, give me a second. So the next question we need to ask is the effect possible effect on the financial statements pervasive? So pervasive means throughout the entire financial statements. If it's not pervasive, it's in one particular account. So an example of pervasive material misstatement is fraud, right? So if the auditor has come in, they found fraud, they think that fraud could be perpetrated throughout the entire financial statements. So they're going to say this is pervasive. Another issue is, let's say they've discovered an issue where every single journal is going to be wrong, basically, whether that's the rounding screwed up or the currency exchange rate screwed up. It's going to affect every single account, every single transaction. That would be a pervasive issue. Or perhaps the accountants have just gone in and just done the wrong thing, but they can't identify particularly exactly where the problem is. It's going across multiple different accounts, multiple different areas. It's basically just saying, look, the whole thing is screwed up. Like, we can't do anything. So anyway, getting off track there a bit, because we are after IS2 inventories. Let me restart. The only account that is materially misstated is current assets, right? So if current assets are materially misstated, that means it's not pervasive. It's only in one particular account category. So therefore, we'd go down here and say no, qualified opinion, right? So let's see the different options. So what type of audit opinion would you issue? Well, qualified opinion because of the flowchart we just went through. Or if we want to summarize it, it's because A, the financial statement's materially misstated, and the misstatement is not pervasive. It's in a particular account, therefore it would be a qualified opinion. All right, so next question is, a client is facing significant litigation as a result of a claim that it dumped oil in the ocean. This is a significant issue which the auditor agrees is adequately disclosed in the notes to the financial statements. What is the appropriate audit opinion? A, qualified opinion, B, an adverse opinion, C, a disclaimer of opinion, or D, an unmodified opinion with an emphasis of matter paragraph. All right, so if we're going to apply the same flowchart as we did for the previous question, I'll just flash it up for a second, but it's fairly straightforward. So the first question is, are the financial statements materially misstated, or can the auditor not obtain sufficient audit evidence? Are any of those the case? If either of those are the case, then we go through the next question, which is it pervasive or not? If the answer is yes and it's materially misstated, it's adverse. If the answer is misstated, not pervasive, no. If it's can't obtain sufficient evidence, and it's pervasive, then it's disclaimer of opinion, and if it's not pervasive, then it's qualified opinion. And if it's not any of that, then it's unmodified, right? So unmodified is the good one. So let's just get back to this scenario. So a client is facing significant litigation. That's the issue, right? So it's not, so we can't say it's materially misstated just because they've got litigation, right? Litigation is a contingent liability, just like, you know, if there's a potential lawsuit or something like that, you know, we don't know for sure that it's an issue, and it's, you know, and they've accounted for, as far as we know, they've accounted for the contingent liability correctly, right? It's not like the previous situation where they had a balance or a dollar value in their financial statements which was 15% too high. There's no indication here that their balance sheet is overvalued, undervalued, or missing something, right? So we can't say it's materially misstated, and we can't say that the auditor cannot obtain sufficient appropriate audit evidence either. So actually, it's probably not going to be any of them. It's probably not going to be qualified, because that would be here. It's probably not going to be adverse, because that would be here, and we're not saying that's materially misstated. And it's probably not going to be a disclaimer of opinion, because we can't say that the auditor can't obtain sufficient information. So it's not any of these ones. So therefore, by deduction, it must be this one, right? An unmodified opinion. So the only thing, you know, they could have made this question a little bit trickier by saying, is it an unmodified opinion, or is it an unmodified opinion with an emphasis of matter? So what an emphasis of matter is, it's just basically whenever there's any significant events that need to be brought to attention of the users, you need to highlight that in an emphasis of matter paragraph. So in this case, fortunately, we don't have to make the decision. It's clearly the answer is D. But the reason there is an emphasis of matter is just because there's very significant, so very material litigation or contingent liability, and we need to just flag that in our emphasis of matter paragraph. So clearly D is the correct answer. Okay, so next question is, the auditor has determined that there is material going concern uncertainty at a client entity due to a reported operating loss, negative cash flow, poor economic circumstances. So basically the auditor is like, well, we don't think this company's going to be around, they're going to struggle to survive. We seriously think they might go bankrupt. So management insists that the going concern basis is appropriate, so that the management is saying, no, don't worry about it, like we're going to still be around in 5 years for sure. But then the auditor is saying, well, you've got negative money, there's economics are really bad, you've got losses in your P&L. But management is still saying it's appropriate for the preparation of the financial statements because the budget shows the company returning to profitability. So they're saying, you know, despite all the negative cash flows, we're going to go to profit in 3 years. We're going to have a positive cash flow in the year after that. So after reviewing the basis for management's conclusion, the auditor agrees with management's decision to prepare the financial statements on the going concern basis and believes that there is adequate disclosure about the material uncertainty in the notes to the accounts. So what type of audit opinion should be issued here? Is it A, a qualified opinion? B, an unmodified opinion with an other matter paragraph? Is it an unmodified opinion with an emphasis of matter paragraph? Or is it an unmodified opinion with a material uncertainty related to going concern paragraph? Okay, so this is a tricky question because what I was saying in the last question, where the only unmodified option in the answers was one with the emphasis of matter paragraph, so we didn't even need to worry about, is it this one, is it that one, is it this one? They're all unmodified, but which paragraph are we including in relation to this specific matter? Now this question has turned that on its head, and now it's testing us on our knowledge of these other paragraphs within an unmodified opinion. But let's just quickly confirm that it actually is an unmodified opinion first of all. Let's try and do this based off the top of our heads rather than referring back to the notes again. So the first question is there a material misstatement? Well, there's nothing in here that indicates that there's a material misstatement. If they said an account is overvalued or undervalued by a material amount, then yes, it would be potentially a qualified opinion. But that's not the case. And also we can confirm that the auditor hasn't had lack of access to information or evidence. That's not noted anywhere in this background. So we know it's not a qualified opinion. So we know for sure that it is an unmodified opinion, but we just don't know what kind of other matter paragraph or emphasis on matter paragraph or this one, material uncertainty. So what we can do is we can just do a Control F in the notes for any of these paragraphs. We can go through one by one, other matter, emphasis on matter, material uncertainty related to going concern. I think the one that kind of stands out the most is this one, material uncertainty related to going concern, because obviously what we're talking about here is going concern, right? So it's kind of obvious that we would check this one first. So what I'm going to do is I'm going to do a Control F in the notes for material uncertainty related to going to concern. So let's bring that up now. All right, there's not many of them, so pretty easy to identify where it is in the notes. So I'm just bringing it across now. So material uncertainty relating to going concern. So the responsibilities of the auditor to obtain sufficient appropriate audit evidence regarding and conclude on the appropriateness of management's use of the going concern basis of accounting in the preparation of financial statements, and to conclude based on the audit evidence obtained whether a material uncertainty exists about the entity's ability to continue as a going concern. Okay, fair enough. If there is a disagreement with management around a potentially material area, unless the auditor is able to gain comfort in other ways, the auditor shall consider the need to modify the auditor's report by issuing a qualified opinion or a disclaimer. So there's no disagreement with management, because it actually says that here that after reviewing, the auditor agrees with management. So there's no dispute there. So we don't need to issue a qualified opinion, which is maybe the only other scenario where this would be the answer. Even if the accounts weren't materially misstated, we might still have a qualified opinion purely because of this IAS 570 clause right here. But the other paragraph here, the auditor should not include an other matter paragraph in the auditor's report, as going concern is not one of the situations outlined in ISA 706. So we know it's not an other matter paragraph. So when the auditor is satisfied that there's a reasonable expectation that the entity will continue as a going concern, the auditor shall issue an unmodified opinion, which is what we've agreed on so far. So we're all aligned there. So when the auditor concludes that the use of the going concern basis of accounting is appropriate but a material uncertainty exists, which is true, the auditor shall determine whether the financial statements A, adequately disclose the principal events, blah, blah, blah. I'm going to skip over that. So when there is adequate disclosure to the existing material uncertainty, the auditor shall express an unmodified opinion and include a section for material uncertainty related to going concern. So I guess the question here is there, or is it? So the question is there adequate disclosure of the existing material uncertainty? So do you think there's adequate disclosure? So, okay, so they believe that there is adequate disclosure about the material uncertainty in the notes. So clearly the answer is yes. So what we can do then is express an unmodified opinion and include a section for material uncertainty related to going concern. So there's our answer there. So it's really just going to be this one here. So an unmodified opinion with material uncertainty related to going concern paragraph. Cool. That was a tricky one. But I mean, if you're running out of time in your exam, like, we could have just guessed it was that as well, because realistically, if the whole question is talking about going concern, it's most likely going to be an unmodified opinion with the going concern paragraph. So, but if you've got time, then go through the whole paragraph just in case, right? So which of the following procedures would normally be carried out by the engagement quality control reviewer? A, participation in the planning of the audit. B, review and approval of the audit program. C, review of significant judgments made by the engagement team. D, ensure that all evidence collected by the audit team is valid and reliable. So what I would do is I just do a Control F for engagement quality control reviewer in the notes. And we will look up the responsibilities of this person. Okay, so I'm just going to drag this across. I've just done this live. So on completion of the audit, assurance firms must complete an engagement quality control review. Okay, so as we can see here, the purpose of the engagement quality control review, or EQCR, is to objectively evaluate the significant judgments made by the engagement teams and conclusion reached in the auditor's report. So it's basically something you do after you finish an audit. You come back and say, well, we just need to make sure that we're maintaining quality on our audits, because obviously when you do an audit, you're just saying, yes, there's no problems in this audit. So how do you distinguish for someone who's doing no work and saying there's no issue versus someone who's doing a lot of work, really quality analysis, and saying there's no issue? It's very hard to tell. People only really know when there's a bad audit when an audit goes wrong. And what that means is when there's audit risk, i.e. in that the fact that they don't pick up an error or fraud or misstatement, and it actually occurs in the financial statements, and it hits the media, etc. So that's why it's really important to do this process. But I think here is the key criteria. It's to evaluate the significant judgments made by the engagement team and the conclusions reached in the auditor's report. And then it also must involve these steps down here as well, but that's the primary purpose. So let's see if that's reflected in the possible answers over here. A, participation. B, review and approval of the audit program. C, review of significant judgments made by the engagement team. So that is the exact wording over here, the significant judgments made by the engagement team and the conclusions in the auditor's report. So, I mean, there isn't a better answer out of the other ones, so I think let's just go ahead and select that one, and that's the correct answer. Cool. All right, next question. The auditor has determined that there is material going concern uncertainty at Client Co. Oh, I think we did this one already. So, unless there's a slight variation, I think we went with a unqualified. Oh, sorry, I think the question was a little bit different. That's my bad. But anyway, let's move on to the next one, just because it was a similar variation to what was already in that question. Didn't go through the full process. XYZ is a listed company with an audit committee comprising 3 of the 8 board members. XYZ's auditor would communicate matters of governance with A, management only, B, management, audit committee, and the board of directors, C, either the audit committee and the board of directors, or both, or D, only the audit committee and never the full board of directors. So for this one, what I would do is I'd just do a Control F in the notes for matters of governance. So that's going to pick up just a couple of examples, only 2 actually, so it should be pretty easy to find in the notes. So here, have a look. So it's talking about the section in reporting responsibilities, page 280, reporting to those charged with governance and management. So basically it says, during the audit of the financial statements, there's a number of matters that need to be communicated, whether it's a particular control deficiency that needs to be addressed, or maybe they're concerned about fraud, or maybe they found a misstatement, they just want to discuss it with the board, or maybe it's about the capability of a certain team member, whether it's the CFO or the finance director or whoever it is. So the responsibility of the auditor, I'm just reading the important text, the red one, is to report to those charged with governance, e.g. the board of directors for a listed company, and not to management, i.e. those with executive responsibility for the conduct of the day-to-day activities of the entity, right? Because at the end of the day, if the one is running the business and the management is the one committing fraud, or if there's a material misstatement, you don't want to report to management, because then obviously they're going to squash that issue. So there needs to be reporting to a separate governance body, which is of course the board. And the board might have an audit committee. So where there is an audit committee, and this is just a subcommittee of the board, like it's still part of the board, they are to report to them, but the auditor may decide to communicate with the whole board depending on the importance of the matters, right? So if it's just a failure of a couple of small controls in the finance team, they might just talk to the audit committee, right? But if they think that there's pervasive fraud as a result of the CFO overriding controls in the business, they might want to say to the whole board, right? It depends on the size of the issue and how important it is, basically. So matters of governance should be discussed with the governing bodies, which would include the board and the audit committee. Okay, so hopefully that's enough information. If not, we can keep reading. So we know that based on what we read in the notes is that we wouldn't communicate to management, right? We want to communicate to the board. And that may or may not include the audit committee. So it's not A, and it's not going to be B either, because it's got management in there. So C says either the audit committee, the board of directors, or both. So, I mean, that seems like the most correct answer, because it says over here that depending on how big the issue is, you might want to talk to the audit committee, or if it's a big issue, they might want to talk to the whole board. So it depends on the importance of the matters. That's what it said in the notes. So that's what's reflected in C as well. So far that's the correct answer. And then have a look at D. So only the audit committee and never the full board of directors. I mean, that kind of contradicts what we said in the notes, where sometimes the auditor might want to report directly to the whole board if it's an important issue. So that kind of, the fact that it says never the full board of directors kind of contradicts the notes, so therefore D is also incorrect. So by deduction, C is the correct answer. Perfect. Cool. So next question. So for which of these engagements is assurance not provided? Is it A, compilation engagement, 2, agreed upon procedures engagement, 3, the audit of prospective financial information based on hypothetical assumptions, Or D, review of financial information where the assurance practitioner is not the auditor of the entity. Alright, so for this one, I would just get to the section in the notes that talks about the different types of services, whether they're non-assurance or assurance services, and just go through them in detail. Now, to get there, you might want to do a Control F based on basically any of these. Maybe start off with compilation engagement. That'll get you to at least the section that's talking about it, and then you can kind of scroll through it and find the relevant section. So I've done that. That's taken me to here. And unfortunately, there's no kind of super quick summary. But we might have to scroll down and go through all the different types of engagements and just recap which ones have assurance, which ones don't. So just starting off with non-assurance services, the ones that don't provide assurance is compilation reports, agreed upon procedures, and comfort letter engagement. So straight away, I can see that the question's asking us which of these is no engagement provided. So we know that based on that table that compilation engagement and agreed upon procedures are both non-assurance engagement. So 1 and 2 we know is correct, but we just want to check off 3 and 4 as well. So far we know that 1 and 2 is correct. Okay, so I mean none of the other ones really have 1 and 2 in there, so we could probably just confirm and just click on that one and that'll probably be the correct answer. But just for the sake of, I would probably just do that now and just get it over and done with, but just for the sake of your knowledge and background knowledge, which will help you, let's just check off 3 and 4 and see why, just confirm that they don't have assurance as well. Because it's always possible that we might have made a mistake somewhere, right? So it's always good to just check off the other options that we know for sure that we got this one right. So let's scroll down in the notes. So previously what we did is we went up to here, we saw compilation reports, agreed upon procedures, no assurance. Also this one, which wasn't mentioned in the question. What I'm going to do now is I'm just going to scroll down, see if I can find the other ones. And if not, what I'm going to do is I'm just going to do a Control F and do it that way. Okay, I'm just going to do a Control F because we hit the bottom of the note. So I'm going to do a Control F based on perspective, see what I can find. If it's going to take too long, I'll probably just lock in 1 and 2 because it's quite clearly the answer. Okay, cool. So what I did is I just did a Control F based on perspective. So you can see examination of prospective financial information. This falls under the ISAs where reasonable or limited assurance is provided. So that is this one. So this one would have some sort of limited assurance provided for number 3. And then number 4, review of financial information where the assurance practitioner is not the auditor of the engagement. We can probably just do a Control F based on that and just go up where not the practitioner is not the auditor. Try that. Yep, so that just did a Control F that picked up this from page 298. So we just want to know if any assurance is provided as a result of this. Let's see. Look, it's probably not worth the time trying to get that final conclusion because it's pretty clear that 1 and 2 are correct and 3 is incorrect. So the only possible answer from this is 1 and 2, and that's the correct answer. Cool. All right, so next question is, in a performance audit, which of the following would the public sector audit be concerned with? 1, whether the entity has achieved its stated objectives. 2, whether the entity has followed relevant regulatory requirements applicable to it. 3, whether the entity has operated in the most economic, efficient, and effective manner. And remember, we kind of briefly touched on this in one of the earlier videos where we said that this was a performance audit was to do with being economic, efficient, and effective, right? So just touching on that again. But it's not necessarily the only thing. So whether the entity has operated in the most economic, effective manner, and then 4, whether the financial statements are fairly presented in accordance with the identified financial reporting framework. So what I want to do is I want to look up performance audit in our notes. So let's put that in. Hopefully not too many options come up. Oh, there's quite a few. Okay, so we'll just do a search of performance audit and find the relevant definition. So I'm going to pull up this section here. There we go. So this is under the category of other assurance engagements. So we've got performance audit. So I just did a control F, took us here. So basically, according to ASAE 3500, the purpose of a performance audit is these three things: economy, effectiveness, and efficiency. So what do each of them mean? So first of all, economy is about the performance principle relating to the minimization of costs. So it's spending as little costs as possible whilst retaining quantity and quality. Number two, effectiveness is the performance principle relating to the extent to which the intended objectives at a program or entity level are achieved. And this is the most important point. And then finally, efficiency. So the performance principle relating to the minimization of inputs employed to deliver the intended outputs. So it's basically delivering the same output with less inputs. So those are the three targets: economy, effectiveness, and efficiency. So economy is minimizing costs, effectiveness is achieving goals, efficiency is minimizing inputs and retaining outputs. So just to apply that in the real world, let's say that the Governor General is doing a performance audit, and of course they'll also do a financial audit separately of each of the departments, but they'll also do these performance audits to see, how effective these governments are spending money. Are they just wasting billions of dollars, or are they getting a lot of bang from their buck? So they might look at two different departments, justice and say who are building prisons, for example, and maybe they spent billions and they're way over time on contract on building these prisons. They spent a lot of money, gone over budget, and maybe some of the prisons they've already built are underperforming. So maybe in that situation, the economy isn't great because they're not minimizing costs. The effectiveness is about achieving goals. So maybe their goals is to build a certain number of prisons and maybe and operate those, and maybe some of them have been closed because of repairs, etc. So maybe they haven't achieved their goals as a result of that. And then finally, efficiency is about minimizing inputs. So maybe negotiating contracts to get them cheaper, but still delivering on that and saving some extra. So maybe they haven't, by not meeting their budgets, maybe they haven't demonstrated efficiency. So anyway, that's just a practical example, but let's apply that to this question. So which of the following in the public sector audit in a performance audit would the Governor General be concerned with? One, whether the entity has achieved its stated objectives. Definitely applicable here. That's to do with effectiveness, whether the entity has achieved its objectives. So this is the most important one as well. So yes, definitely number one is the public sector, the Governor General would be concerned with. Number two, whether the entity has followed relevant regulatory requirements applicable to it. So that, again, that doesn't really fit into the economy, effectiveness, efficiency. That's something completely different, right? So number three, whether the entity has operated in the most economic, efficient, and effective manner. Absolutely. That's kind of combining all three of these together. And then four, whether the financial statements are fairly presented in accordance with the identified financial reporting framework. So this is testing to make sure that you know what a performance audit is. It's a completely different audit to a financial audit, right? So the governor, they're going to do both. They're going to do a financial audit and a performance audit, but this is making sure you're not getting mixed up between the two. So 4 is incorrect for that reason. So just to recap, the answer was 1 and 2, because this was about objectives and efficiency, economic and effective manner. So the answer is going to be clearly 1 and, which one was this one? 3. There we go. 1 and 3. Cool. All right. Which one of the following can be considered as an example of an effectiveness performance indicator? So answering this question, it's going to be critical that we understand what effectiveness actually means. So which of the following can be considered as an example of effectiveness performance indicator? A, reduction in the cost of outpatient care in a public hospital. B, a reduction in the number of caseloads for social workers at a welfare centre. C, increase in the number of patients treated daily in a hospital emergency ward. Or D, reduction in the number of flu cases occurring after a flu vaccination program. So I think these kinds of questions are really tricky because it requires you to know the difference between efficiency and effectiveness. So if I just bring up the notes one more time, the difference between efficiency and effectiveness. So effectiveness is all about achieving goals and objectives, whereas efficiency is about doing things with less input, retaining the output, or keeping the input the same and generating more output. So it's basically doing more with what you've got, basically. So you need to understand those definitions and then apply it to these different situations. So because this one's asking for effectiveness, we need to look for goals, objectives, achieving objectives and goals. So the first one, reduction in the cost of outpatient care in public hospital. That's probably more on the efficiency side, right? Or economy, actually, because you're focusing on the cost side, so minimizing cost resources. So probably not effectiveness. B, reduction in the number of caseloads for social workers at a welfare center. Look, it's hard to kind of say that that is an objective, but potentially, look, right? So far, it's the best one so far, but it's not quite there. It's probably more to do with the fact that there's less demand. That doesn't necessarily mean that they've achieved their objective at the welfare center, right? The welfare center's goal might be to treat more caseloads for social workers. If that's dropped, that doesn't mean that they've achieved it, right? That just could be an economic thing. I mean, I don't mean like economic goal. I mean like, you know, the economy's gotten better, but that doesn't mean they've achieved their objective, right? But so far, it's still the best answer, but we're trying to find the most correct answer. So C, increasing the number of patients treated daily in a hospital emergency ward. Depends if their objective is to, treat more patients, right? But that, again, that's not necessarily linked to achieving those targets, right, or those objectives. It could just be driven by, a greater population, for example. This is why it's a hard question, right? Because it does seem like you could argue that they've achieved their objective, but it's hard to specifically link it to an objective when it could be other things driving it. More people living there, COVID, more disease in the area. Maybe they've combined a hospital with another one. So it's not really a strong case for achieving an objective. But so far, both of these are okay, not great, right? So hopefully D gives us a better option. So reduction in the number of flu cases occurring after a flu vaccination program. Okay, so this is one that we probably can link to objectives, right? If you have a flu vaccination program, what do you think the objective is going to be? It's going to be to immunize many people and reduce the number of cases in society, right? That would be an obvious objective of that program. And if they have reduced the number of flu cases, then they've probably achieved that objective, right? So this one presents the strongest case for setting out an objective and also some data to support the fact that they've achieved that objective. It's a hard question, but let's click on that and it's the correct answer. Cool. All right, so I think we've probably done enough at this stage to get the message across in terms of how to approach these questions. We've got so many questions for you to practice here in your own time. And, if you do enough of these, you're going to ace the final exam. Just do as many of them as you can. Any questions that you kind of struggle with or have failed, make a note of them and then practice them over and over again until you get them right. And also, the more you practice, the faster you're going to get, so you don't need to keep referring back to your notes all the time. You can just click on an answer, and that's kind of where you want to end up. Anyway, let's do one final question, and then we'll close off this video, and then we'll go to the final module, Module 5. Cool. So, last question. A performance auditor collects financial information from all of the hospitals in the state of Victoria. Notice it's a performance auditor, not a financial auditor. So the auditor then analyzes the data collected by calculating and comparing the number of patients treated to the cost of the doctors and nurses at each hospital. In other words, treatment per dollar. Which of the following best describes this analysis? This analysis, so first I'm going through the multiple choice answers. A, the analysis provides a measure of the economy of each hospital. B, the analysis provides a measure of the efficiency of each hospital. C, the analysis provides a measure of the effectiveness of each hospital. And D, the analysis provides a measure of the value for money provided for each hospital. So realistically, there's only going to be one of three options here, right? So it's either going to be, based on the notes again, economy, effectiveness, or efficiency. So economy is about using less costs and resources within the operational requirements, right? B is, so maybe it's just scaling down your services, for example, right? B is effectiveness. That's your ability to achieve objectives. And then finally, efficiency is minimizing inputs while still delivering the same intended output. So it's usually keeping the outputs the same but reducing the inputs, or potentially, but less likely, increasing the output with the same level of inputs. But either way, your ratio of input to output is more is improved. So in this case, what we've got here is we have got a number of patients treated to the cost of doctors. So is there any indication that the number of patients treated is reduced and therefore they're just cutting the number of doctors? Because that would be economy. It doesn't seem to be the case in this contextual question. What seems to be happening in here is they're keeping the same number of doctors, right? So the same number of inputs. The inputs is exactly the same. but they're treating more patients per doctor, right? Because the number of treatments per doctor has increased, right? Or it's implied to have increased. Or alternatively, maybe the cost per doctor has decreased and the number of doctors has decreased and the number of patients may have decreased or stayed the same, but it's proportionally higher per doctor treatment. Either way, that is an indicator of efficiency because it's talking about number of resources used per treatment, right? That is efficiency. So clearly it's going to be B, and that's the correct answer. Okay, cool. So let's leave it there. It's not too difficult once you learn the skills and the approach and do enough practice questions. You might come across one or two hard ones, but overall, if you just do as many as you can, you should be fine for your final exam. Anyway, I hope you found this video useful, and I'll see you in the next video. Thanks for watching.